Hello and welcome to this explainer. If you're a GST registered business owner navigating the tricky world of cross-border transactions, well, you are in the exact right place. Today, we're unpacking the absolutely crucial and honestly sometimes a little confusing rules around zero-rating international services. Okay, let's dive into this.
First things first, let's get our definition straight. When a service is zero-rated, you are charging your customer GST at 0% instead of the standard 9%. But here's a critical distinction for your business compliance, and this is exactly where a lot of folks trip up. It is still a taxable supply. The rate just happens to be zero.
Now, what's really interesting about this slide is the implication for your bottom line. Think about it. Even though you're charging 0% GST to your client, because it remains a taxable supply, you can still claim input tax credits on your business expenses, assuming, of course, those expenses are used to make taxable supplies as usual. It's a massive benefit for your cash flow, but you absolutely have to get the rules right to claim it.
Here is our roadmap for today. 1. The Zero Rating Rulebook. 2. Navigating Section 21(3) categories. 3. The 3 core concepts. 4. Real-world case studies. And 5. Apportioning mixed supplies. Don't worry, we're going to move step by step from the dense legal theory right into practical, everyday case studies.
Okay, Part 1. The Zero Rating Rulebook. And specifically, dispelling the big myth. Let's tackle the most common compliance trap that businesses fall into right out of the gate.
Look at this myth. It is so incredibly easy to assume that just because your customer is sitting in an office overseas, you can just automatically zero-rate the service, right? Wrong. Sadly, the tax authorities do not see it that way at all. Let me be super clear on this. Location alone does not guarantee a 0% rate. Misinterpreting this can lead to massive, unexpected standard rate tax liabilities for your business down the road. The GST Act dictates exactly which services qualify, and you have strict conditions you must satisfy.
Let's move to Part 2, navigating Section 21(3) categories, and see how this builds into the actual legal framework governing these rules.
So, Section 21(3) of the GST Act systematically organizes international services into very distinct industry categories. As you can see, Column 1 covers transport and goods. So, for example, Section 21(3) G and H covers services performed on goods meant for export. Column 2 is for general services across multiple industries, covering rules like Section 21(3) J and K. And then Column 3 handles highly specific sectors like maritime and aviation. This classification is actually great because it means you don't have to guess. You can pinpoint the exact provision tailor-made for your specific service sector.
Moving right along to Part 3, the 3 core concepts. Now that we know exactly where to look in the GST Act, we are going to extract the 3 vital pillars you have to evaluate under Section 21(3).
If you read through certain provisions within Section 21(3), you'll notice specific phrases that constantly pop up. We can translate these into 3 core concepts: under a contract, directly benefit, and directly in connection. I want you to think of this as your ultimate go-to mental checklist for zero-rating qualification. Let's break them down. Concept number 1 applies heavily to subsections like Section 21(3) J and K. You have to ask yourself, do you actually have a contract? You must be able to establish a factual contractual relationship with your customer. Now, don't panic. This doesn't always mean a 50-page, heavily lawyered document. It might be a comprehensive service-level agreement, sure, but it could also be a simple service requisition order or even just a clear chain of email exchanges outlining the business arrangement. The key is you just have to factually answer, did you enter into a contract with your customer?
Concept number 2, which also really applies to Sections 21(3) J and K, asks, who directly benefits from your service? You start by examining the terms of that contract we just talked about. If the contract explicitly names the recipients, they're generally considered the direct beneficiaries. Once you know who they are, you have to make absolutely sure that customer actually belongs overseas. But how do you actually prove that to a skeptical auditor?
Well, here's how you prove they belong overseas. For individuals, it's based on their usual place of residence. For a business, it's about where their business or fixed establishment is located. To definitively prove this, your business can use these 4 administrative approaches. 1. Just directly verify it with your customer. 2. Get written declarations stating they have no Singapore presence. 3. Check their incorporation status on the ACRA business portal. Or 4. Do a bit of sleuthing on their materials. Examine things like making sure there are no local Singapore addresses hiding on their letterheads or their website.
All right, concept number 3. Is the service directly in connection, or DIC for short, to specific goods or land? This applies when your services are inherently tied to a physical thing.
You have to meet two very strict conditions here. First, the goods or property must actually exist at the time you do the work. You can't zero-rate work on hypothetical goods. And second, your service must be clearly linked to them, meaning your service involves physical work done on those goods, physical contact that establishes their attributes, or something that directly affects their nature or value.
Section 4. Real-world case studies. And this brilliantly illustrates why we need to pull these abstract rules out of the textbook and see how they apply in the wild.
Let's look at our first scenario. We have Prime Pipes, a Norwegian company with absolutely no presence in Singapore. They buy pipes from Singapore meant for export to Japan. Now they engage a Singapore firm, Checkforce, to perform an independent physical inspection of these pipes before they're shipped out. Prime Pipes is fully capable of providing the complete export documents. The big question, can Checkforce zero-rate this inspection service?
Let's walk through Checkforce's exact systematic approach to get this right. Step 1, because they are doing physical work on goods that are destined for export, they identify that Section 21(3)(g is the perfect fit. Step 2, they confirm Prime Pipes is indeed an overseas customer with no establishment in Singapore. Check. Step 3, they verify the goods will be exported to Japan, an intention that was clearly communicated right at the start. Step 4, they obtain the complete export documents. Because they rigorously followed these steps, Checkforce's services successfully qualify for zero rating under Section 21(3)(g.
But wait, there is a catch. 60 days. Checkforce only gets to keep that zero rating if they obtain all the required export documents and written confirmations within a strict, non-negotiable deadline of exactly 60 days following the completion of the services. Do not miss that deadline, guys, or literally all of that careful compliance work goes straight out the window.
Okay, let's wrap up the difficulty with a more complex scenario involving overseas persons, where the service isn't directly related to goods for export. Security Limited is an overseas software company. They hire CyberSide, a tech company based in Singapore. CyberSide provides two very different functions under the contract: pre-sale services, like marketing and product demos, and post-sale services, like actual on-site hardware installation in Singapore. Can CyberSide zero-rate all of this?
We really have to contrast the two distinct functions here. For the pre-sale marketing, CyberSide is contracting directly with the overseas company. The direct beneficiary is overseas, and any demo hardware used is just a presentation tool. It's not physical work on the goods themselves. So the pre-sale stuff easily qualifies for zero rating under Section 21(3)(j. But what about the post-sale services? Well, on-site hardware installation is physical work that affects goods located right here in Singapore, benefiting customers in Singapore. That immediately triggers a standard rating.
Which brings us to Part 5, apportioning mixed service supplies. This is the exact solution for handling contracts that contain both zero-rated and standard-rated elements, just like CyberSide's post-sales services.
When you have a mixed contract, you must apportion the supply value. You can't just lazily treat the whole thing as standard-rated or zero-rated. Step 1, carefully separate the standard-rated components from the zero-rated ones. Step 2, apply a reasonable proxy that reflects the actual split of the work. This could be the market prices for each separate component, the cost you incurred, the time your team spent, or the revenue generated. Now, the crucial point is, Step 3, you have to keep incredibly detailed records explaining why you chose that specific proxy to support your calculations. Proper apportionment and bulletproof documentation are exactly what will protect your business when an IRS audit inevitably happens.
Before we wrap up, I want to leave you with this golden rule of compliance, straight from the source material. When in doubt, standard rate your supplies, unless the customer proves they belong outside Singapore. It is always, always better to lean on conservative tax planning rather than crossing your fingers and risking a massive penalty for incorrect zero rating.
So, I want you to look at your current business operations today and ask yourself honestly, are your international contracts secretly exposing you to standard rate tax liabilities right now? Do you actually have the hard documentation to prove your customers belong overseas? It is absolutely time to check your beneficiaries and review your Section 21(3) compliance immediately. Thank you so much for joining me for this explainer, and happy analyzing.